Okay, you can see the screen, right?
Yes, sir.
Okay. So this is the question. Heo Tech Company fictitious reported net income 2.3 million for the year ended 30th June, and a weighted average of 800,000 common shares outstanding at the beginning of the fiscal. The company had outstanding 30,000 options with an exercise price of 35. No other potential dilutive financial instruments are outstanding over the fiscal year. The company's market prices averaged USD 55 per share. Calculate basic and diluted EPS. Okay. So basic EPS, what is the formula?
Net income minus preferred dividends upon weighted average of outstanding shares.
Huh. Outstanding shares. Okay. So now net income is how much? Net income is 2.3 million. Okay. Minus preferred dividend. Is there any? No. Right. Divided by weighted average number of shares. Weighted average of 800,000. Just calculate this.
Yes. 2.875.
Okay. Then so that is basic EPS. Okay. Then diluted EPS. Diluted EPS is equal to, again I'll write the same numbers. Now I'll make the changes. I'll modify it, right? So now they said 30,000 options, which are exercise price of 35. Okay, so 30,000. So when we issued 30,000 options, we must have got 30,000 into 35. How much this is coming to?
1,05,000.
So we received this much of cash when we issued options. So now, and at the later stage, let's say you are going to issue, or you are going to convert that into shares. So in that case, 105. So no, this much money you have received. Okay. Now one share is 55 rupees. Now you have to use this much money, 105,000. So how many shares you will be able to buy it back from the market? Just calculate this, cross multiply.
19,019.
19,019. So this many shares,
90.
90. So this many shares, I will buy it back from the market. I am supposed to issue 3,000. So remaining is what I'm going to create. Just take the difference.
Ten 10,910.
Now solve all this.
2.836.
Now, since this is lower than this, so this is the diluted EPS. Check. Is it
Yes.
matching?
Yes, 2.84. Yeah. It's matching. Okay.
You are writing all this?
Yes, I'll just write.
Okay, once done, you let me know, then I'll move to the next question.
Okay. Done, sir.
Okay, so then the next question. So this is the next question.
Yes.
The diluted EPS calculation using the if converted method for convertible debt. Okay, Oponox company fictitious reported income of 750,000 for the year ended 31st December 2018. The company had a weighted average of 690,000 shares of common stock outstanding. In addition, the company has one potential dilutive security, 50,000 of 6 percentile convertible bonds, convertible into a total of 10,000 shares. Assuming a tax rate of 30%, calculate opponent's basic and diluted. So, have you calculated basic? Can you calculate basic EPS?
Yes, yeah.
Calculate.
Two 2.875.
Okay. Net income is 750,000 minus preferred dividend. Preferred dividend is 6% of 50,000. Did you take that into consideration?
No, sir, I'll just recalculate myself. 1.09.
Right, you understood this step because you are paying preference shares dividend. Is there preference shares? No, no. No, no, that is bond. That is not preferred stock. It is zero only. You are just accepting whatever I am speaking. You are not cross-questioning only. This is not preferred stock dividend, right? This is bond.
Okay.
How much is it coming to? This is zero only.
1.09.
Now diluted EPS. Now when I'm diluting, it is convertible into a total of 10,000 shares. So I will create 10,000 new shares. Now when I will create 10,000 new shares, I don't have to pay interest now. How much interest do I have? I don't have to pay. That will be 6% of 50,000. Just calculate how much that is. 6% of 50,000.
3,000.
So 3,000. So that will be the addition. 3,000. But I have to pay tax on that one. So tax is how much? 30%. So
30%.
I will be left out with only 70%. So 1 minus 30% will be 70% of 3,000.
2,100.
2,100 is here, right? Now you calculate all.
1.07.
1.05, which is lower than
07.
basic EPS. So this is the diluted one. Check the answer.
Yes, 1.07.
Okay. Then the next one is this question. Question number 25. Where might an analyst look for details covering the full extent of a company's capital resources? Balance sheet, management discussions. So full extent of your company's capital resources, covering the full extent. So now MD&A, remember I told you MD&A is about SWOT analysis. You will come to know
Yes.
what they are planning and how they are aiming to achieve. So that is where you will get to know how they are planning to use their capital resources as well. Because balance sheet, if you see, balance sheet is telling you what has happened in the past.
Right.
Okay. Uh, Balance sheet is just telling you what has happened in the past. Okay. Whereas here, what might an analyst look for details covering the full extent of a company's capital resources? See, you can read this. See, the balance sheet discloses what an entity owns. That means all what has already it has done, and what an entity owes, and the owner's interest in the net assets of the company at a specific point in time. While the balance sheet can include a Section summarizing non-current liabilities. This usually includes just a single line item listing the total amount of the company's long-term debt due after 1 year with no information about the company's capital resources.
Okay.
Well, the balance sheet can include a section summarizing non-current liabilities. This includes just a single line item listing the total amount of. Okay. Yeah. MDA, they will basically give you an idea. Okay. Did you read MDA? Any MDA
Yes.
did you read? It will analyze their SWOT, that is strength, weakness, opportunities, and threats. Okay.
Okay.
So that's a theory.
So, and module quiz.
Module quiz, you have sent that also.
No, sorry, it's in Shazam.
Okay. Okay. Pleasure. So what is the module quiz?
28.4.
Question number?
Second.
An analyst has gathered the following information about a company. Okay. How many shares should be used in computing diluted EPS? That means weighted average number of shares we have to calculate. So 30,000 shares outstanding. 30,000 shares outstanding. So 1 lakh warrants exercisable at 50 per share. Okay. Average price. No, actually it is just okay. See, 1 lakh shares exercisable at 50. Now we are supposed to convert it average share price. Year end share price we will ignore. Okay, that is just 1 day's price. We will focus on average share price. Okay, so 1 lakh warrants you have received at the rate of 50. Just calculate this. 50 lakhs, correct?
Yeah.
So 50 lakhs you have received. Now you have to buy back at the rate of 55. So one share is 55. So for 50 lakhs, how many shares can you buy back? Just cross multiply.
90,909.
90,909. So remaining, you are supposed to give 1 lakh shares. So remaining you are going to create. So now you just take the difference.
9,091.
9,099. So initially 3 lakh shares. So now plus 9,099. So 3 lakh 9,099. You may check the answer also.
Yes, sir. It's true.
Hmm.
So why do we ignore the year-end share price?
Because when you are buying back, average price will tell you more accurate value than year end. Year end is just one day's price. It might be overvalued, it might be undervalued.
Okay.
So see, you have to use either 55 or 60. Okay, now which one will you use? Average will tell you more an accurate number, right?
Right. Yeah.
Okay, because year end means only one day, 31st December's price, that is.
Right.
Only 31st. So 31st December, if the market is highly down, the price will be down. If it is highly up, the price will be up. So that is not the right way. No? So you will take the average value. Year end is just to confuse us.
Okay. So in one sum, they had given the market share price, and they had chosen that.
Market share price means this one, this warrant only.
Oh, yes, I think so. I don't remember, but
No,
it was
market means what? This is also average only, average market price.
okay.
You have to focus on average or year end. Both are market price only.
Okay.
Okay. Average market price or year end market price.
Okay. So the third one.
Yeah. An analyst has gathered the following information about a company: 100,000 common shares outstanding from the beginning of the year. Okay. So diluted EPS. Okay, first we will calculate basic EPS then. So net income is what? Net income is 125,000 minus uh,
No
preferred
preferred.
stock. No, nothing. Divided by number of shares. Yeah, 100,000 only. Just calculate this. So it will
One
be
point.
1.25. Uh, 100,000. Okay, so now diluting. 1,007% $100,000 par bond convertible into 25 shares each outstanding as of the beginning of the year. Okay, so convertible into 25 shares. So 1,000 bond is convertible into 25 shares each. So one bond will give you 25 shares. So 1,000 bond will give you how many? Cross multiply.
25,000.
So 25,000. So 25,000 shares will be created plus 25,000. Now when it is created, uh, you don't have to pay interest now. Then that means that will become your income. So how much interest are you paying? 7% of 1,000 into 1,000 will come, correct? Because one bonds value is 1,000. So total bonds value will be 1,000 into 1,000. How much is it coming to? 10 lakhs or 1 million.
1 million.
From this 7%.
70,000.
So 70,000 you are going to save. But when you save 70,000, you have to pay more tax than 40%. So you will save only 60% of that 70,000.
42,000.
42,000. So, acha, 42 means this one is 42,000. Now you calculate.
One 1.36.
1.36. Now
Yes.
you see, I must have told you, right? This diluted EPS is supposed to be lower than the basic EPS. Then only we will accept it.
Yes.
Okay. So in this case, it is higher. So what is my diluted EPS? My diluted EPS will be 1.25 only.
So I didn't understand.
Okay. See. Yeah. Now this is the diluted EPS. So these shares, one is equity shares, another one is preference shares or preference shareholders. Now, not preference shareholders. Oh, sorry. This is not shares. No, this is bond. Acha, okay. So convertible bond now, but same logic. See, convertible bond. So convertible bond means it is up to you whether to convert or not to convert.
Right.
Okay, you are the bond holders. Okay, so some logic is same only, equity and bond holders. Now it's up to the bondholders whether to convert or not to convert. So initially equity shareholders were earning 1.25. Now if bondholders convert it into equity shareholders, everybody will earn 1.36. That means these equity shareholders are getting more now.
Yes.
Now if they are getting more, it is coming from somebody's pocket.
Yes.
Now who is that somebody? Bondholders. This is bondholders' interest that is getting transferred to equity holders.
Okay. Yeah.
So that means now bondholders, will they convert? They will decide not to convert because
Yes.
it is their interest which equity holders are getting the profit.
Okay.
They are getting the benefits, right?
Right. Yeah.
Okay. So bondholders will say, I don't want to convert.
Okay.
Yeah, you understood? It's like, two friends. One is having, like less food. Another one is having more food. And they are saying, now you have the option to combine this food together. But if you combine, what will happen? Who is losing?
More food.
A and B. So B is losing. Now B has to decide. Then he will say, no, I don't want to mix the food then,
Right. Okay.
because you are losing if you do that. Okay, so that's why. And on the other hand, A and B, here you are having less food and here more food, and you have the option to mix. Then what will you do? You will decide to mix because it will become more.
Yes.
So that's why here, because it is more already after dilution, you will not accept this one. You will not convert. So it is anti-dilutive.
Yeah.
It's called
Okay.
anti-dilutive. So only 1.25 is accepted. Just check.
Yes, sir. It's 1.25.
Yeah, yeah.
So diluted EPS is when the shares are already converted to common shares or preferred shares.
Diluted EPS is assuming if it is converted.
Okay.
So if it is, we are assuming that if it is converted, then what will happen? It will come to 1.36. Then we will say no, it is anti-dilutive. They will not convert. Then my diluted EPS is also equal to 1.25 only.
Okay.
You
Understood.
can, you can pull out any annual report today. Just type DMART annual report like this, and DMART or TCS annual report, and then you search with diluted EPS. You will find basic EPS and diluted EPS also there. You will get more conviction.
Okay.
They will not mention all the formulas and all that thing, but you will know that okay, here it is mentioned like this. Okay.
Okay.
What is the next one?
The fourth one.
They are asking only the shares. How many shares should be used? So 50,000 common shares outstanding from the beginning, warrants outstanding. Okay, stocks is selling. Okay, this is all about calculating weighted average number of shares. So first, 50,000 common shares outstanding from the beginning. Uh, then warrants outstanding all year on 50,000 shares, exercisable at 20 per share. Warrants outstanding all year on 50,000 shares. Okay, exercisable at 20. Okay, stock is selling at year end. Okay. Stock is selling at year end for 30, 25. Okay, so it is just, we will see whether it has to be converted or not. See, exercisable 20. Stock is selling at year end. As I told you, year end price doesn't matter. Okay. Then
Yes.
average price is 50. Now you see here, exercisable means initially they took 20. Now the price is 15 only. It will be converted into equity provided its price is more than 20.
Right. Yeah.
So that's why now this is also anti-dilutive.
Okay.
So you will not take, this also, you will not convert only. So net you will have only 50,000 shares then.
Okay.
Okay. This is anti-dilutive. This one is also because the average price is lower than the exercise price.
Right. So it will be 50,000 only.
Yes. Yeah. You
Okay.
may check the answer also. Yeah.
Yes, sir. 50,000.
Hmm.
That's it, sir. That's all the doubts.
Okay. Okay. So next one, I did the tallying thing, right? One
Yes.
balance sheet, one basic level balance sheet we did, right? Okay.
Yes.
Okay, fine. So you have time like half an hour more?
Yes, sir.
It's fine, right? Okay. Okay. So now I'll tell you the format of cash flow statement. Okay, format of cash flow statement. Um, Cash flow statement categorized into three types: cash flow from operations, cash flow from investments, cash flow from financing. Okay, now this cash flow from operations can be categorized into two types. One is direct method and another one is indirect method. Okay, direct method and indirect method. Okay, now direct method is, okay, direct and indirect method. So yeah, so this is the format: direct method, cash collected from customers. Okay. Then cash used in the uh, production of goods and services. So that means cash paid for purchases. Then cash, okay, paid for expenses. Then cash paid for interest. Then cash paid for taxes. That means this number, these all are minus. All these are minus, total some number. Okay, this is the format. Now further, how can I elaborate this format? Cash collected from customers. Okay, cash collected from customers. Cash collected from customers will be, the formula is sales. Okay, when you do sales, you are collecting cash from them, plus decrease in accounts receivable. Accounts receivable. Okay, sales plus decrease in accounts receivable, and then plus unearned revenue. All these are cash collected from customers. Unearned revenue. Okay. Yeah, you understood this one. Say for example, sales of 1000 rupees plus decrease in accounts receivable. So account receivable has come down. That means we received cash there also. Let's say
Yes.
200 rupees we have received and 100 rupees unearned revenue. So overall 1300 you have received. This formula is okay.
Yes, sir.
Okay. Now suppose if in the question there is increase in account receivable, what should you do? You should make it minus. That's it.
Okay.
Okay.
Yes.
If it is decrease in account receivable, it is plus. That means we are receiving. Okay.
Okay.
If it is increase in account receivable, we will minus. The next one, cash paid uh, for purchases. Okay. Cash paid for purchases will be cost of goods sold plus increase in account receivable, increase in inventory, because this together constitutes purchase, plus what else can come in purchase. There was one more. Accounts payable. Accounts payable perspective, increase in accounts payable. Um, Accounts payable purchase, cash paid for purchases. Our suppliers here. Decrease in inventory purchases. Cost paid for purchase. So cost of goods sold is purchase. Increase in inventory is also purchase. Then cash paid. No, so decrease in accounts. No, increase in accounts. Decrease in accounts payable. Cash paid for purchases or to suppliers. I think supplier is a better word. Uh, yeah, yeah. I should not write purchase. Let me write suppliers. It's easier to understand. So I paid COGS. I paid for increase in inventory, then decrease in accounts payable. These two are called purchases. Now it's fine. Cash paid for suppliers word I should write. Okay. Is this fine? Have you understood this one? Like cost of goods sold is again 1000. Increase in inventory is 200. Okay. And then plus, so this much I have purchased actually. Okay. Out of that 1000 I have sold. 200 is in inventory. Then also previous accounts payable I have paid 100. So overall 1300. Is it okay?
Yes, sir. Sir, in cash collected from customers, increase in accounts receivable, it would be plus, right? Why would it be minus?
This one?
Yes, if it's increased.
It will be minus. Why it will be minus? Because account receivable when it is going up, that means you are not collected.
Okay. Right.
Decrease in account receivable means you have collected cash.
Okay. Okay.
Then it will become uh, credit sales.
Right. Okay.
That's why then we will minus credit sales.
Okay. Understood.
Okay, cash paid to supplier, then operating expense. Operating expenses, you take salaries or wages. So cash paid for operating expenses. So here I'll take wages. Okay, example wages. So opening wages plus uh, opening wages plus wages minus closing wages. Okay, this is the formula. Why? See, here we use one method called as inverted Y or tree method. Tree method means like this, inverted Y or tree method. This is opening wages. Imagine opening wages. Where will you find opening outstanding wages? Okay, opening outstanding wages. So opening outstanding wages, let's say 1000 rupees. Then this year wages is 700. This is this year. So total wages will be what? 1700. Out of that 1700, let's say uh, 1700. Now the left closing outstanding wages is 1500. So what does that mean? What happened to the remaining 200? Initially 1000,
Yeah.
then this year accumulated 700. So total 1700. But closing wages I'm showing only 1500. Closing outstanding wages. What must have happened to the remaining 200?
Not sure, sir.
That you must have paid it. That's
Right.
why it has come down.
Yes.
Right. You must have paid. That's why it has come down to 1500. It's like your
Yes.
fees was 1700 rupees. Now your fees has come down to 1500. What must have happened? You have paid the fees.
Correct. Yes.
Okay. So cash paid as wages is equal to 200. How did you get this 200? Adding these two and deducting this closing. This is what it is. Adding these two, deducting the closing.
I will write this down, sir.
Oh, yeah, yeah.
So can you scroll up a bit?
Hmm. 1 minute. From where do you want to write?
Yes, sir, from here only.
Okay.
Done, sir.
Hmm.
Done.
Hmm. Okay, so this one I'll write again. Cash paid for operating expenses. So let's say opening amount 1000, then plus wages. Wages means this year expenses. Wages expenses is 700. So total became 1700. Closing outstanding wages will be, let's say, 1500. So cash paid as wages. 200. This is wages expenses, 700.
Done.
Okay, after this, operating expenses, then interest. Interest also same way. Cash paid as interest is equal to opening interest payable plus interest expenses minus closing interest payable. Okay. So that is opening interest payable. So you can use this tree method for direct method. Okay. This is called direct method. So let's say again 1000 plus interest expenses 700 1700 minus let's say closing interest payable 200. So now here cash paid as interest will be 1500. Okay.
Okay.
Then next one, cash paid as tax. Now this is little complicated. Cash paid as tax will be, first you write all this, then I'll do the last one.
Okay. Done, sir.
Okay, cash paid as tax is little lengthy. See, it will be opening tax payable plus opening deferred tax liability. Deferred tax liability. Okay, deferred. What is that? I will let you know later. Okay, then minus opening deferred tax asset. This is one group. Then plus tax payable this year. And then this will give us the total. So let's say this is 1000. Opening deferred tax liability is let's say 3000. Deferred tax asset is 500. So it will be 4000, 3500, right? No, 3500. And then tax payable this year is, let's say, 1500. So how much is the total? 4500, correct?
Yes.
4500 is the total. Then now closing tax payable. Closing tax payable is, imagine, 800. Then plus closing deferred tax liability is 3100. Okay, minus closing deferred tax asset. Let's say that is 300. Now just calculate all this. So first you calculate all 800 plus 3100, 3900 minus 300. So 3900 minus 300 is 2800, correct? Correct, no? 2800.
3900 minus 300. 3600.
Oh, sorry. 3009. Yeah, 3600. So now 4500 minus 3600 will be cash paid as tax.
$900.
Okay. So this is the one. But if you want to write it like a statement, it will be that lengthy. It will be opening tax payable plus opening deferred tax liability minus opening deferred tax asset plus tax payable, then minus closing tax payable plus closing deferred tax liability minus closing deferred tax asset. Okay, see, all these are one group. Then the second one and minus the third group. Understood this one?
Yes, sir.
Okay, now what is this deferred tax asset, deferred tax liability? Okay, so there is a separate reading for this one, but still, you might get some doubts, so I'll just explain it now. Deferred tax assets and deferred tax liability. Okay, deferred tax assets means what? Say, for example, imagine, see, there are two types of tax reporting. One is that financial reporting. I mean, two types of reporting. One is financial reporting, another one is tax reporting. Financial reporting is for us, to know how our company is performing. tax reporting is to know how much tax to be paid to the government. Okay, say for example, there can be some differences between the way we are doing accounting and between the way government wants us to do accounting. Say for example, let's say uh, sales happened. Sales happened for 1000. Let's say depreciation is the only expense. We are depreciating, let's say, at uh, 50 percentage. No, we are depreciating at 25 percentage. Let's say we are depreciating. There is some asset, 1000 rupees asset. 1000 rupees asset, and it is we have decided to depreciate at the rate of 25 percentage. Okay, and so 25 percentage, so that means what, 250 we will depreciate, and then imagine that is the only expenses. Then we will have profit. So profit will be what for us, 750. Okay, now from this 750 we will pay tax. Tax is, imagine, 30 percentage. So into 30 percentage you do, so 30 percentage,
225.
225 I will pay tax. Now over here, tax perspective, sales, imagine government says, government, this is my EV company, electric vehicle company, and government says that I'm allowing you to depreciate at the rate of 50 percentage per annum. They are giving me some subsidies, incentives, and all this. So I want to capitalize this. So what will I do now? I will depreciate at 50 percentage, means what, it will come to 500 now.
Yes.
Okay, now my profit is going to be 500, correct? Okay. Into tax. Tax is 30 percentage.
150.
So 150, yeah. 150 tax. Now you see, government says pay me only 150, but I know I'm supposed to pay 225. So there is a difference. Now which one will I abide by? 150 or 225? I will go by whatever government is asking. Government is asking 150. Why will I pay 225?
Yeah.
I will pay only 150. But I know there is a difference of 75. 225 minus 150. So I need to record that as well. So this is my liability, 75. I'm supposed to pay, I know. But government is asking 150, I'm paying 150. So I will create deferred tax liability. That means I'm saying I will pay later stage. How later stage you will come to know now. You understood this term, deferred tax liability?
Yes, sir.
Okay. Then next year, imagine what happens. 1000, again depreciation of 250 because 25 percentage of 1000. So that comes to 750. Again 30 percentage comes to 225. Here again 1000 minus 500 equal to 1500 into 30 percentage comes to 150. So now again 75. So 75 I will add up again here. Okay. Then third year. So here my deferred tax liability is 150. Third year minus again 250 equal to 750. 30 percentage comes to 225. Now you see my depreciation is 0 here because it's already over 1000 rupees. Is it okay?
Yes, sir.
Equal to, now my profit is 1000. Now government says pay me 300, whereas I'm supposed to pay only 225. Now what should I do? Okay, now I'm supposed to pay 300 now. Now that means I'm paying extra 275. No? So now what will I do? I will reduce minus, from this 150. Is it okay?
Yes, sir.
Okay, see now I'm adjusting like this. Okay, then fourth year, 1000 minus 250 equal to 750 into 30 percentage comes to 225. Here 1000 into 30 percentage comes to, government says again give me 300, but my accounting tells me I have to give only 225, so I have to pay 300, but from this liability I will reduce again. See now at the end, after 4 years, you see what is happening here. Okay, I have overall depreciated how much? 1000 rupees, right? I have depreciated here also 1000 only. So it is the same depreciation, it is just a timing difference. How much tax did I pay? Calculate all this.
Yeah. 900.
And here
900.
So you see, finally I'm paying the same tax. It is just about, because of the subsidies and all, I'm delaying the payment. Initially I did not pay, later I paid. That is also a benefit for me. So it's like government said, you don't pay initially, you pay me later.
Okay. So which one do companies usually choose?
Whichever, no, see, if government is giving some benefit, they will take it. But they also want to know what is exactly happening in their company. So this is what they are going to see for running their business.
Okay.
This is what they are going to see for paying tax to the government.
Okay. Understood.
Now, similarly, deferred tax asset also can be created. Now, instead of, see, this is just one example of depreciation I told you, because of which these differences are coming. Now, there are plenty of other transactions. Okay, so wherein then, say for example, donation is there. Now, donations, imagine you are paying money to a political party because without that, your business is not going to run. Now, when you pay donations to the political party, what will happen to your profit? That is an expense donation.
Yes, yeah.
What will happen to your profit? Profit will come down.
Yes.
Now, if you show that to the government, that means tax reporting. Tax reporting says that I don't recognize all donations. You did not start business with your for giving donations to anybody, right?
Right, yeah.
So according to this calculation, the profit will be high. So the tax will be high. Then you have to pay more tax, they will say, and you have to pay only accordingly.
Yeah.
So this kind of discrepancies are all possible. Okay, so at that time that you are paying more than what you are supposed to pay tax. So if you are paying more than what you are supposed to pay, then you will create deferred tax asset because it is your asset now.
Okay.
You understood what I said? Like
Yes.
in donations, you are paying donations. So in your financial reporting, you will mention donations because that is the truth. You have paid donations, but your profit is down. So your tax should also be down. But tax reporting says, no, I don't care about all your donations. Then that means you have to pay more tax and you have to listen to them only. You will end up paying more tax. So you will create deferred tax asset at that time. So both also can exist, in a large organization. And there is a separate reading on this one where we will be discussing various transactions where deferred tax assets will be created, deferred tax liability will be created. Right now, you just have to know the meaning that deferred tax liability means you are supposed to pay more, which you are deferring. 75 rupees, you see here 150 and 225. 75, you are deferring.
Okay.
Okay. So, yeah. This is the formula. Fine. I think beyond this it will be too much for you, I guess. Right? Or you can still you want me to continue?
So we can continue for 15 minutes.
Okay, fine. So okay. So till here you understood, right? Okay.
Yes.
Till here. Okay. So now I'll give you some sums, simple sums to practice all this then.
Okay.
Okay. You have to calculate purchase. So how to calculate purchase now? So opening inventory, cost of goods sold, purchase. So what you should do is, see, all these are connected one. So how is this connected? See this here. Cost of goods sold, opening inventory, purchase, this purchase, opening inventory. These are all connected. This is accounts payable. All these are connected one. So in direct method, you can always use this tree. Okay, opening inventory. Opening, you will keep it at the top. Opening inventory 10,000. Closing inventory 20,000. Cost of goods sold. Okay. See, opening inventory plus purchase will give you some number.
Yes.
Okay. And so remaining only will go into cost of goods sold. Have you understood this one?
Yes. Yeah.
Okay. Remaining only will see from this total closing, it will go as cost of goods sold and then closing inventory. So see, this total should be equal to these additions total. Both should be same.
Yes.
So I'm not able to get the total from here. So I can get the total from this side, 35,000. Okay.
Yes. Sir.
Then 35,000. So if this is 35,000, then what is purchase? Then 35,000 minus 10,000, 25,000. Is it okay?
Yes. Sir.
Or you can simply say opening, if you want it like a statement, opening inventory plus cost of goods sold plus purchase is equal to closing inventory, whichever way you are comfortable. So 10,000 plus cost of goods sold 15,000 plus purchase is X is equal to 20,000. Now you shuffle and find out. Is it okay?
Yes. Sir.
Then I'll move to the next one. Opening accounts receivable 170,000. Then closing accounts receivable 50,000. Sales 100,000. Credit sales 50%. Cash received from account receivable is what? Just try.
Yeah. So sales is how much?
1 lakh.
Okay.
Shall I do?
No, sir, 1 second.
Okay.
Is it 1,70,000?
Yeah, correct. Yeah. So opening account receivable 170,000. Then closing account receivable 50,000. So here plus credit sales. This is credit sales will be 50,000. So 2,20,000 minus 50,000 will be 1,70,000 cash received. Okay.
Okay.
So if you want again this in the form of an equation, opening account receivable plus credit sales minus cash received is equal to closing account receivable.
Okay, sir.
Third one, opening accounts payable 190,000. Credit purchase 70,000. Closing accounts payable 120,000. Cash paid to accounts payable. Huh.
1,40,000.
Yeah, correct. Opening accounts payable plus credit purchase. $140,000, right? Okay. Then next one, sales, 170,000. Opening inventory, 50,000. Closing inventory, 90,000. Gross profit margin, mm, you have to calculate cash purchase, then cash sales, cash paid to accounts payable, cash received from accounts receivable. Okay, just you try on your own first.
Okay.
So try all different ones. So this is related to inventory, related to accounts payable, related to accounts receivable. Just you try once. You may not be able to do whatever you can do, you do, then I'll do it.
Cash sales is 1,53,000.
Cash sales. But how cash sales? I'm saying all sales are credit.
Okay.
100%. Na?
Okay.
You are not getting late, no? You have time?
Yes, sir.
Oh, okay.
Total purchases is 1,25,000.
Total purchase is 1,25,000. Yeah, that is right. Yeah. Okay. Shall I do this now?
I'll just try
Okay. Try.
cash.
Okay. Try.
Cash received from accounts receivable 1,40,000.
Correct. That is right.
Cash paid to accounts payable I'm not getting.
Cash paid to accounts
Accounts
payable.
payable.
Okay. Okay. Yeah. Okay. So I'll do this now. See, first inventory related. So okay. Opening inventory. With opening inventory, we have plus purchases. Then that total will go as closing inventory, and the remaining will be cost of goods sold. Okay. Then we have accounts payable. So this one will be opening accounts payable, then opening accounts payable, then uh, credit sales. And this is closing accounts payable and cash paid. Okay. Then this is account receivable. So this one is opening accounts receivable plus accounts receivable. No, this is credit purchase. No, accounts payable should be credit purchase. So this is credit sales. Then accounts receivable credit sales, closing account receivable, and then cash received. Right. Okay. So sales 100% credit sales we know. So 170,000 will come here. Then 50,000 opening inventory. So opening inventory 50,000. Opening inventory 50,000. Then closing inventory 90,000. Gross profit margin is little different, so we'll see this later. Opening accounts payable is 10,000. Closing accounts payable is 130,000. Opening accounts receivable is 60,000. Closing accounts receivable is 90,000. Okay, so now this one we can quickly fill up. Okay, so this comes to 1,70,000 plus 60 is 2,30,000 minus 90. So 2,30,000 minus 1, so 1,40,000, correct?
Yes.
Is 1,40,000. So now the clue that we are supposed to use is gross profit margin. Now gross profit margin means what? Sales minus cost of goods sold. Cost of goods sold. Sales minus cost of goods sold will be gross profit. Gross profit margin is 50%. Na? How much? 50%. So gross profit margin's formula is what? Gross profit divided by sales. Okay, is equal to gross profit margin. So I know this is 50%. Sales is 170. Then I can come to know gross profit. 50% of 170,000. How much is that? 85,000, correct?
85,000, yes.
So this will come to multiply this, you will get 85,000. So if gross profit is 85,000, sales is 170,000. So I know then this has to be how much? Take the difference, 85,000. Correct?
Yes.
So 85,000 will come here. Okay, so this total I can add up here. How much is that? 91 lakh, 1,75,000, correct?
Yes, sir.
Total. So 1,75,000 minus 50,000, 1,25,000.
Yes.
This is filled up. Okay. So now cash received from cash received. This is 1,40,000. This we have filled up. Cash paid, cash purchase, and cash sales. Cash sales is 0 because all are credit. And cash purchase. Okay. So now this is total purchase. This is credit purchase. Now how do we find out? See here. Suppose if I think that all these are 100% credit, if I assume, then in that case it will become 135, 125. Okay.
Yes.
125. So 10,000 and 125 comes to what? 135. Now 135, so cash paid will be 0.
Okay.
So because I don't have any other clue, so I'm taking this entire. So here it is matching also, because
Yes.
total is 135. Here accounts payable is also 135. So it is matching. Cash paid is 0. So cash paid is 0. Cash purchase is also 0. Then all are credit purchase. That fine? Okay.
Yes, sir.
Clear. That's it. Then okay. So I'll just send this video to you in some time. Okay, in an hour's
Okay.
time, I'll send it. Fine. We'll stop now here.
Okay, sir.
Okay, you have to practice this. Okay, and then we will do one full-fledged sum from the book. Okay,
Okay.
from the Schwezer. Okay, but you have to practice this very well before we go to that one. Okay.
Okay, sir.
Okay, we'll stop now here.
Okay, sir. Thank you.